So most of us have gone through that phase where you find a strategy that really works. Let's say you're on the 1 hour or 4 hour time frame, and for about 2-3 weeks it really works and you are making a lot of money. Then in the next 3 or 4 weeks the strategy just completely stops working and you keep losing money. And then you change the strategy again, find another one that really works. Then what happens? That one works for a short period of time, and also what happens? It changes again. In this video we are going to talk about why your strategy stopped working and how to be able to trade a particular strategy for a very long time. So one of the very first reasons why strategies change is that the market condition relating to the strategy has changed. Now what do I mean by this? Now there are 6 market conditions in the market. For the uptrending market there are 2 types, which is the up volatile and the up quiet market. Now let me explain what this is. So for the up volatile, you can see that the market goes up, comes down, moves up, comes down, moves up, comes down, and then moves up again. Why? Because they are sharp. The market is very volatile. You can see that there are sharp retracements. They moves up. So this is still an uptrend. You can see this is still an uptrend, but there are sharp retracements that occur very deep into the trend. You understand? So if you are a trend trader, this becomes very difficult for you because you go into profit, you go back into you lose majority of your profit, you go into profit, lose majority of profit. You understand? This can be very shaky for a trend trader. But if you are somebody that likes to catch retracements, okay, the up volatile market is the perfect market for you. Why? Because when the market moves up and comes down, you can catch a retracement here. The second type, which is the up quiet movement. Now the market moves up, doesn't do much of a retracement. You understand? It doesn't do much of a retracement and just continues to go up. Sometimes it doesn't even have any retracement. It just continues to go up. That is the up quiet movement. Now this, if you're a trend trader, if you're somebody who trades with a trend or swinging, the up quiet market is a very good market for you. Why? Because there are no sharp retracements and you can enjoy holding the trades for a very long time. But if you are somebody who catches retracements, your strategy is based on catching retracements so that you can enter the trend. Anytime you try to catch a retracement here, you understand what happens? The market moves. Anytime you try to catch a retracement here, the market moves. So in this condition, when the market is up and quiet, you lose money. You understand? But when the market is up and volatile, you make money. Why? Because when the market moves, you can catch a retracement down and buy again. You understand? So this is just for the uptrend. Now I'm going to show you for the downtrend as well. So for the downtrend, we have 2 market conditions as well, right? We have the down volatile and then we have the down quiet. You can see this is a downtrend, right? The market comes down, retraces, comes down, retraces, comes down, retraces, comes down, right? So this is a downtrend, but it is what? Consolidating or moving in a range, right? It is moving down, but it's moving in a range. So this is called a down volatile, right? So if you have a strategy that is based on catching retracement of trend, this is where your strategy works really well. You understand? When the market comes down, you catch a retracement to the, you sell back down, catch a retrace. This is sweet for people trading retracements, right? But then if the market becomes down and quiet, these usually happen when there is a market crash, when something bad is happening in the economy or something. The market just drops and keeps dropping, right? Now you can see the market becomes down and quiet. It doesn't give you any chance for you to enter on a retracement. And when this happens, most people tend to enter here trying to catch a retracement. Then what happens? The market moves sharply down and that's what blows the account. Then you end up saying the strategy does not work. It's because the strategy, you are not applying it to the right market conditions. So there is another set, which is the sideways movement, right, that we are going to talk about. I'm going to show you that one as well. So when the market is not moving upwards or downwards, it is moving in a sideways market, right? So for the sideways market as well, there are 2 market conditions. The first one, which is the quiet sideways, which is the market is moving up and down, up, down, up, down, up, down, quietly, all in a range, not going anywhere, right? But then there is the volatile sideways. The market is still moving up, down, up, down, up, down. But the only difference is that when the market is moving down, it doesn't move sharply down like that. It just behaves in a volatile manner, behaves in a very volatile manner. You understand? So these are the 6 market conditions which affect the market, right? And in this quiet sideways and quiet volatile market, if your strategy is based on a trend trading strategy, over here you are going to lose a lot of money because the market is not moving anywhere. So the best thing to do is that you should know the market condition that works really well with your strategy. So the second reason why your strategy does not work is because you have poor psychology. You understand? For a strategy to work, you need to be able to execute it perfectly and with a sound mind. You understand? Majority of us have not had mastery over our psychology yet. We do not know how to cut losses short and let our winners run. We do not know how to control fear, control greed, control the fear of missing out. So in subsequent videos, I'm going to do videos about all these, how to master fear, greed, fear of missing out, when you're missing out opportunities and all those things. Sometimes we don't even take profits when you are supposed to take profit. So the third and final reason why most strategies fail is because we do not do any back testing. You just find a video, or let's say the strategy on YouTube or on Telegram or Instagram. You just start trading it. Why? Because your mentor tells you that strategy is very, very profitable. No, what you need to do is to back test that information, that strategy, to see where your entries are supposed to be, where your exits are supposed to be, how it has performed over the past 3, 4, 5, 6 months. Then with that data, you can be able to tell, okay, this strategy is very, very profitable in this market condition. You understand? So backtesting lets you know what kind of market condition your strategy also works. So these are the main reasons why your strategy stopped working. Now, like this video and subscribe. I'll be dropping more content very soon.